Good morning, welcome to Ainsley News. It's end of week. Today we're talking the AUD, the Aussie dollar. It surges as the ECB destroys the bond market. Last night the AUD smashed through the 75 cent mark for the first time since June 2018. Waking up this morning with gold down 1.6% and silver down 1.2%, you may have thought the spot price had an ordinary night, but in USD terms, they held firm. It's all this rising AUD, which has gone from sub 70 to now over 75 since the beginning of November. No coincidence then that this period has also seen gold in AUD terms fall from 2,700 to the current 2,435, and silver fall from 3,410 to 3,180. This has been the risk-on trade of everything's awesome relation or reflation trade in full force, an environment which the AUD likes. By comparison, that same period has seen Bitcoin rise from 19,200 to the current 24,400 after reaching the 27,000 at the beginning of December. Between the two real monetary assets, Bitcoin has overshot the correlation trend against these real yields, and gold-silver is actually lagging at the moment, for now. This next chart here is showing gold versus real yields. Currently sitting around that 17.76. A lot of this AUD strength can be attributed to the meteoric rise of ore, which last night broke through $150 per tonne on fears of a cyclone in the Pilbara region. Check out this graph here. Iron ore price takes off. And indeed it is, since February this year. Those real rates of the previous chart we just shown are under increasing downward pressure too, as central bank stimulus suppresses headline rates, but inflation, subtracted from headline rates to get real rates, inches up and always threatens to rocket in response to said stimulus. Topically last night, the ECB, or the Europe Central Bank, went even deeper into stimulus, increasing their own QE program by Euro $500 billion to $1.85 trillion and extending it out to at least March 2022 as it struggles to overcome Europe's double-dip recession. Despite that, the euro strengthened as the stimulus-addicted market was hoping for. What stimulus was provided has already been priced in. That, of course, put more pressure downward on the USD, the euro being the major pair, and upward, of course, of the AUD and USD pair, but did not stop the AUD climbing even stronger against the euro. Such is the extent of the ECB's bond buying program, funded with newly created euros, that Bloomberg calculated they're about to own 43% of Germany's sovereign bond market and 40% of Italy's, putting them on course to own over half of those entire sovereign bond markets in the next quarter. That is quite staggering when you think about it. The Bank of Japan long since moved past such a milestone, turning their attention to Japanese shares via ETFs, to the point where they are now the single biggest owner of shares on the Nikkei. Where does this end? Rules are being thrown out in desperation. This from Bloomberg. Needless to say, the implications are profound for what's left for bond traders. Japan's fixed income trading floors have been decimated over the last decade, and the markets are so dead that sometimes not a single government bond trades in a day, despite the fact that there are over $8 trillion of Japanese debt in existence. The Bank of Japan owns around half of it, and sometimes close to 90% of individual issues. And now that the ECB is wantonly buying up everything, it's Europe's turn. It didn't have to be this way. When the ECB first started buying bonds in 2015, it was tied to strict purchase rules in an effort to avoid accusations of monetary financing. The central bank was allowed to buy no more than a third of the country's bonds and had to weight purchases of euro area member states by the size of the economy and population. All these rules were thrown out this year when Christine Lagarde scrapped these limits for the central bank's pandemic purchase program, with another 1.85 trillion being pumped straight into bond markets, including the extra amount announced on Thursday. As investors and institutions look for safe havens, the traditional go-tos of sovereign bonds and gold are looking more and more favourable towards gold as this plays out. We have, of course, seen more institutions putting their reserves into Bitcoin of late as well. One thing is certain with the AUD heading towards 80 cents, and that is the RBA will not be happy, and it will be keeping the pedal to the stimulus QE metal to try and contain it. Outside of the ore story, Aussie exporters are battling a high AUD and a Chinese trade war. Another thing is certain, and that is that central banks are not unleashing unprecedented stimulus because everything is awesome. The effects of stimulus are driving up financial assets and to unprecedented highs, giving the impression of awesome, but not the reality. For Aussie investors looking to get into gold, silver, and platinum amid all this stimulus, currency debasement, and the reality of the economy, it talks to the high AUD makes for a nice cheaper metals to buy for the time being. Australia at 0.1% interest rates and CPI at 1.6% is firmly in negative real rate territory. That is gold's sweet spot. Bonds, as the alternative, are looking more and more unattractive. Well, that's news for today. If you are interested in grabbing any of our physical products, jump over to ainslieBullion.com.au for gold, silver, and platinum, ainsliewealth.com.au for Bitcoin and all of its friends, and of course the gold silver standard, Ainsley built and backed, stored at Reserve Vault. We've tokenized gold and silver, and you can grab it from there. We'll catch you on Monday for more news.